Hi, my name is David Hartman, and the company I chose to research for this project is Berkshire Hathaway. Berkshire Hathaway, headquartered in Omaha, Nebraska, is considered a multinational conglomerate holding company. What this means is they operate in many different countries, they own multiple businesses, and they don't actually sell a product or a service, but they own other businesses that do. Right now, they're the eighth largest publicly traded company in the world. In 1996, where this chart begins, they went through a stock split because one share back then cost around $30,000, and most people could not afford to invest in this. So the company split into Class A and Class B stock. A share of Class B stock has 1/1500th the value of Class A stock, and Class A stock has more voting rights. Warren Buffett is the CEO and one of the wealthiest people in the world, entirely due to his success with Berkshire. Almost all of his net worth is from owning Berkshire stock. He's widely considered the greatest investor of all time. And one quote I like of his is "Price is what you pay, value is what you get," because it shows the true difference between price and value, which is hugely important when it comes to investing. Berkshire's portfolio is always changing as management is constantly buying and selling new businesses. Some of the biggest companies they invest in are Apple, American Express, Bank of America, Kraft Heinz, Kroger Company. They wholly own, which means they own 100% of Geico, Duracell, Dairy Queen, and Fruit of the Loom. And the two biggest holdings they have are in Apple and Bank of America, with around $130 billion worth of stock in the two companies combined. Because of COVID, they were forced to sell all their airline stocks, which they actually just recently acquired. And those included American Airlines, Delta, Southwest, and United Airlines. So getting to the financial statements, the balance sheet shows consistent increase in assets and almost no change in contributed capital, which also means an increase in liability, of course. The income statement shows a positive net income for the previous 3 years, which makes investors happy. 2018 had increased expenses, which hurt the net income and earnings per share, but it still remained positive. And looking at the statement of cash flows, the primary source of cash came from operating activities, while the primary use of cash came from investing activities. So, as I mentioned before, assets have been steadily rising, which indicates constant growth in the company, especially between 2018 and 2019. You see a huge jump in the number of assets. Sales revenue has also climbed at a steady rate, meaning they have invested in reliable companies that continue to bring in consistent sales. Net income remains positive. Even during 2018, when expenses were so high, they still returned money to shareholders, which is represented in the positive earnings per share year over year. And again, 2018 had very high liabilities. That's why you see a low net income and low earnings per share. So getting into the financial ratios, investors should use caution when comparing Berkshire to the insurance industry average, as Berkshire isn't a normal company. They are a conglomerate holding company. So they have businesses in many different sectors, and their numbers will deviate from the average quite a bit. It is worth noting that Berkshire outperformed the insurance industry average in return on sales, return on assets, and current ratio. Return on sales was 8 percentage points higher than the average and indicates they are turning sales into profits very effectively. Return on assets was more than double the industry average at 10.5% and indicates the company's assets are generating revenue. And again, going back to the balance sheet, they are increasing assets year over year. So that's very important. The current ratio shows their ability to pay off debts and allows them to invest in a new company without selling off current assets. And that is higher than the insurance industry average also. So everything I mentioned so far is a good reason to invest, in my opinion. Berkshire is led by one of the greatest investors ever, and they follow a strict guideline when investing in new companies. Always decide the value of a company before worrying about the price you're going to pay for it. The stock is well diversified, meaning they can avoid bankruptcy due to market crashes caused by global events such as the pandemic that's happening now or recessions like the one that happened in 2008. Financial information shown through balance sheets and income statement shows positive returns and healthy operating numbers. And over the past 55 years, the S&P 500 has gained around 19,800%. In that same time, Berkshire's gained over 2.7 million%. So they are historically outperforming other stocks. I can't think of many downsides to investing in Berkshire Hathaway over the long run. It may not be appealing to investors who want to make a lot of money quickly because the stock price sees pretty steady fluctuations over a long period of time rather than huge changes that happen more quickly. But that is most stocks in general anyway. Because of the current stock price rising over the past month and the uncertainty of the pandemic, it might not be a good time to invest right at this moment. They are largely involved in the insurance industry, mainly through their entire ownership of Geico, and the pandemic is having a huge negative impact on the insurance industry. So maybe the timing isn't right at this exact moment. In conclusion, I would absolutely advise a friend to invest in Berkshire Hathaway as a long-term investment that will bring consistent returns. Berkshire's management and investing strategies are second to none. They're guaranteed to bring consistent returns and likely to outperform others in their industry. The way their business is set up makes it very easy for the company to avoid significant losses and quickly jump into more profitable industries. And most importantly, their financial numbers, specifically their gains in assets and the return on asset number, have been proof that they can bring shareholders the profits they desire. They may have an off year every now and then, like they did in 2018, but they will always remain profitable. Thank you.